Okay, ladies and gentlemen, let's get our forecasting session underway here. My name is Jack Suyderhoud. I used to work at the business school at UH. I'm happily retired now, except for doing occasional things like this. One of the things I'm a pleasure of doing is thanking Bank of Hawaii for sponsoring this particular session. And I have a story that's not related to Bank of Hawaii, but to the other bank. A few years ago, the late Leroy Laney and I were making a presentation on Maui. That was our economic, what we called our economic forecast session, or sometimes also called by us the economic outlook. We didn't want to be pretentious and call it forecasting, call it economic outlook. We were on Maui, and Pam was going to introduce us, and she came up to us and asked, "What do you want to be called? Forecasting panel or the outlook panel?" And we said, we didn't know, we didn't care. I thought, well, she said, well, why don't we just average that out? You're the economic outcast panel. But that doesn't apply to today's panelists. Paul Brewbaker, Peter Fuleky, Eugene, Tian, and Mike Hamasu. Anyway, they're going to be talking in that particular order. My role is to ask some questions at the end and to keep everybody to a strict 15-minute limit. Good luck with that. But I will try to enforce that as much as possible. And then that should leave us with a good half hour for Q&A at the end. All of you know the panelists, I'm pretty sure, and if you don't, all the information's in the bio. But unlike the economic outcasters, I think this is a group that's best called the usual suspects. Okay, so let's start with Paul, and we're off and running. And by the way, they're kind of going to go, the order of presentation is going to go from Paul down to Mike and kind of narrowing as we go along, sort of weaving down that way. Okay.
Thanks, Jack. Are we using this? Not at all. Okay.
Aren't you mic'd up?
I am mic'd up. Am I mic'd up?
Oh.
And this is the clicker. Turn my mic on.
You're on.
Now it's on.
Now it's on. Is it on?
Yeah.
On. This is not coming out of my 15 minutes. The what? Oh. The mic? Oh. Under the lay. Okay, no jokes about that. Okay. Okay. Oh, yeah. I know. Ready? Set? Go. Can you guys put the big one on, or do we have to look at this one? Oh, that's so we can see like the next slide. Got it. Okay. Oh, okay. Okay. Wait. Okay, thanks you guys for inviting me as always. I usually go last, so sorry. I told them, let me go last. Is this working now? Yes. And so they asked me to do macro, and we talked a little in emails about tying in with the supply constraints. So I'm trying to do a little bit of both. So here we go. Is this working? There. Okay, I listened to everybody this morning. I thought, okay, let me do some economics. Okay, so the pandemic came, aggregate supply declined, but demand declined, but so did aggregate supply, universally, simultaneously, right? So there was no change in inflation during the pandemic for the first year. And then when the recovery came, aggregate demand outstripped the return of aggregate supply, which also became less elastic in the sense that, now this is an analogy because that's actually inflation, and aggregate output on the horizontal axis. But the point is, the supply chain impediments and just getting the factories back in order, the disarticulation of global production and distribution led to this inflation jolt, which for those who still think there's a Phillips curve, and I do, turned out like this. So inflation spiked at the tail end of the improvement in unemployment. And then if you look on the right-hand side for the engineers, right, you have the demand impulse from fiscal stimuli and whatnot, and the aggregate supply impulse going in orthogonal directions, right? So the economy moves as an average of those two vectors. Where are we right now? The Fed's pulling aggregate demand in the opposite direction, right? So that's going to reverse. I have to turn around, sorry, like this. And we're hoping for resolution in the supply chain disruptions. So the bottom line here is you need to be looking at both aggregate demand and aggregate supply sources of the inflation impulse that monetary policy is now dealing with. And monetary policy can't fix Putin's invasion of Ukraine and the increase in the price of grains that came from that shock, right? So therein lies the same dilemma we faced in the 1970s without the roll-up of inflation expectations. So I can actually read this from here. So make believe, blah, 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 blah. Why the composition in the title? Because the composition of the recovery had the peculiar impact of aggravating the supply constraints. Here's personal consumption expenditure. Oh yeah, awesome. There's personal consumption expenditure pre-pandemic, a drop in consumption, right? There's your recession, a consumption-led recession. We all stopped, after we stocked up on toilet paper, we all stopped going out and doing stuff. And when the stimuli came, right, everybody knows, because they took our classes, that a windfall income has a lower consumption propensity than permanent income. So people paid off their debt, they added to their savings. Seth loves this story. Seth and I have talked about this a lot. Look at all the savings that's been built up and that's still out there waiting to be spent. And there were 3 stimuli. And when the third one came, we got back to the pre-pandemic trend for personal consumption expenditure, but the composition was anomalous, right? People were spending stuff on goods, but they weren't traveling. Services did not come back and still haven't come back. And some of us probably aren't going to eat out as much. I'm sorry for the restaurant panel this morning, but it's not, we changed the way we do things, right? I've never been to a Target, I take that back. I haven't been in a Target or a Lowe's or Home Depot in 2 years, but I spend money there all the time. I get on my phone, I drive my car by, and they throw stuff in the back of my car, right? If it doesn't come directly to my home. So the goods part of the economy exploded. Well, they didn't build any more factories while we were out for COVID. You see what I mean? And even those that were there didn't come back that fast. On top of which, the sheer gap between gross domestic income and gross domestic product has never been as wide as it is. This is Seth's point, has never been as wide as it has been in the last couple of years, right? Ordinarily, it's a couple percentage points of GDP, usually negative. Right now, it's 4 percentage points above GDP, right? So you've got all this income, all this savings, and it's created an inflation problem that people are freaking out about, particularly one political party. And we need to understand how this is distinct in Hawaii versus, wow, my timer didn't work. Where am I now? About 5 minutes? So let's look at the metrics. Here's one you don't usually see, the GDP deflator for Hawaii, right? I had never actually looked at this. And so I rebased it to 2017. I'll come back to why I chose that year. There's the 2% growth path or inflation trajectory that the Fed explicitly is now committed, or it has been for a decade. It continues to be steadfast in its assurances that it will get us back there. And there's the inflation that happened beginning in March, or essentially 4 quarters ago. We only have first quarter data for Hawaii. breaking down into the 2 percentage points that are the underlying goal of the Federal Reserve and the 5 percentage points that show up anomalously in this last year. Same thing for the Urban Hawaii Consumer Price Index, where we can split out the core part of inflation for people who don't eat or drive, right? The headline rate includes those volatile components. And again, now this is over a slightly longer period, approaching 16 months at this point, or 18 months. But again, you have this kind of 7 percentage points. CPIs run hotter than right? The Spears indices run hotter than POSH indices. Breaking down, like that slide I skipped over too quickly, into about a 55% aggregate demand, 45% aggregate supply decomposition. Why the Hawaii index? Why Hawaii inflation? Because it's lower than the national average, and that also tells us something important. Basically, we don't have the juice that you see in a lot of the rest of the country. This recovery is not as strong as it's been on the mainland. So we're running at 7%, the US closer to 8 or 9%. In both cases, you can see the turn begin. That may be partly response to the Fed and anticipation of what the Fed was going to do, but it could also be, with any luck, supply chain improvements. And to work backwards now to the US personal consumption expenditure deflator, where again we have a core and a headline component. You can see more strikingly the fact that the core component is actually leading downward now. These are quarterly data, so we're in the middle of whatever's happening right now. There's that Fed goal. We live in a monetary union, right? An economic union. You are free to move around the aircraft. And perfect capital mobility, right? Perfect factor mobility. The exchange rate between here and the mainland is 1. So in the long run, inflation rates have to converge. Otherwise, there'd be an arbitrage opportunity. And you can see that on average, Hawaii inflation is within plus or minus 2 percentage points. And because of the nature of the relative weakness of our recovery, we're actually in one of these low ebbs, like the Hawaii becalmed period that Chris Grande wrote about in the late 1990s. Another big distinction between what we're experiencing right now is that it's more like what happened in the World War II and 40s and 50s territorial era, where an unusual exogenous shock, a global shock occurred that was inflationary, rather than these periods of crescendo over 10 or 15 years where inflation expectations, wound up and took a Herculean Fed effort to bring down, right? Paul Volcker had to do a slam dance on the US economy to get mortgage rates down from the 13% Christine was talking about to the 3% we had last year. And then finally, when you decompose into the actual line items of the CPI, you can see this is, again, urban Hawaii. It's all about fuels, food, and vehicles, new vehicles and used vehicles. While my son was waiting for his new Ford F-150, lives up in Denver, which allegedly means he needs a pickup truck. While my son was waiting for his new 6 months for his Ford F-150 to be delivered. Why? Because they couldn't get the chipset from the foundry in Taiwan, right? And all the 5 to 7 nanosecond chips are made in Taiwan, and they all went into Chromebooks that you bought for your kids when you pimped out a home office so they could go to school at home, right? So there's acres of Ford F-150s and Ford Broncos waiting to have their chipsets installed so that they can actually be delivered. While my son was waiting for his new truck, he bought a Chevy Suburban, used Chevy Suburban for $5,000 and flipped it 3 months later for $8,000. The hell? I didn't even know the used car. I didn't even know used vehicles were in the CPI until this year. I'm not kidding. How long have I been doing this? Okay, Jay Powell can't fix oil, drought, and why my son needs a Ford F-150, right? Not to mention a Ford Bronco, for which the waiting list is like 18 months, 2 years, up to 2 years. So that's crazy stuff. And here's the problem. We're going to use monetary policy because it's really the only tool we have, except for those who think more creatively, like everybody who came before us in today's panels, and think about the supply side. And the 3 tools they have are forward guidance to keep inflation expectations anchored. Quantitative tightening now, where they let the balance sheet roll off, now probably 95 billion a month, I think it is now, as of this month. And of course, the overnight interbank lending rate, the Fed funds rate. So quickly in order, inflation expectations remain relatively well anchored. The term structure of inflation expectations is inverted, so the 5-year expectation is maybe 2.75%, and the 30-year expectation is 2.25%. And most of that 25 to 50 basis point inverted term premium is a risk premium. It's an inflation risk premium, which will abate if the Fed manages to pull off this soft landing it's trying to engineer. The second point about the balance sheet, you can now see it rolling off, right? When there's a crisis, confidence is liquidity, and so to supply the liquidity, primarily through bank reserves, the Fed buys securities, and that deep pool of securities, that deep pool of liquidity in reserves of Federal Reserve district banks is slowly being transformed. It's being drained away, and it's slowly being transformed into that yellow piece, which is reverse repos, a kind of think of it as a short-term loan, right? The overnight reverse repos. And finally, they tell us what their interest rate, right? They're going to raise the rate by 0.75%, like in 2 weeks. I don't think anybody, we all know that, right? They pretty much telegraphed everything they're going to do. Well, here's the forecast. You don't. Why listen to the outcasts when you have the Fed's interest rate forecast, right? That's why Leroy and I no longer stopped working at banks, because in those days they had Ben Bernanke's forecast. So what do we need Brewbaker for? Peter's going to pick up on some of these themes, so I don't want to dwell on this too much. And so let me conclude by thinking a little bit about where labor markets fit into this, because they're the other half of the Phillips curve, and there's some weirdness going on there. Employment, payroll employment. I think Sean's going to talk about the local numbers, but payroll employment nationwide has been working its way back. It's higher than this previous peak, but it's not back to trend. And it may never get back to trend for reasons we can talk about in the Q&A. But these two other indicators I've put in, the job openings, you see that middle arc, which are super high, right? 2 job openings for every unemployed person in America. Wow, really? And so when your son or daughter tells you they can't find a job, tell them you're not trying hard enough. And then quits, which has been, right, the great resignation. Now, both of those are rolling off, right? You can see the curvature. So we may be going back to a more normal market. These things also tend to recede during and prior to an incipient recession. But I think those are both indicators that the labor market this time is different, that firms may be hoarding labor. Look how much Fuleky it was to lay everybody off, then bring them back and rehire, but they didn't want to come back to the office, and then all this blah, 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 you're going to pay them more, right? So we may not see the kind of unemployment event. That's the reverse argument of the one that's on your iPhone today. So if you go read those papers, there's a Brookings paper, and there's another one that says, no, this one's going to be gnarly. So, okay, fine. On the day I'm making this presentation about unemploymentless recession, you're telling me the unemployment is going to be worse. I just point out quickly that there are the gap between where we should be in terms of labor force participation and employment to population ratios is, 1 million people died, yo. They're not coming back to work. Did we forget about that? Bruh, 1 or 2 people in Hawaii die of COVID every day. Bruh, if 1 or 2 people died in a school shooting every day in Hawaii, you guys be losing your, right? But now we're all, bruh, where's your mask? Okay, I'm just saying, that's how we roll in America. And they're not coming back. Plus, there's a bunch of guys, they're not going to go to work unless you pay them to work from home, ever. So, in fact, we've had John Fernald come through here a couple of times. He spoke at the Jackson Hole conference, and he told everybody, total factor productivity growth, which has caused the GDP trend to decrease, because, right, ever since the iPhone dropped, productivity growth has flattened, right? Ever since social media, Facebook, yup, lower total factor productivity growth. TikTok, worse. And he presented a paper last week, and guess what? Virtually all of the total factor productivity growth since the pandemic came from working from home. So the rest of all you guys aren't even contributing. So we have a problem in that we may not ever get back to that old trend, right? It's a long-term productivity growth problem, or it may be after several decades of deceleration. Ever since Al Gore invented the internet and before he discovered global warming, we've had this problem, and that's why I indexed to 2017 for the GDP deflator earlier, because you thought it was bad on the mainland. Hawaii is 15 percentage points away from where it would have been had it maintained its 2% GDP growth trend, the same one you get by downloading the latest version of the app, right? And here's the thing, I just forgot what the thing was. Oh, I scaled, it just happens, I just noticed this, right? We're at 95% of the 2017 level. Right, the scale worked out awesome, right? I scaled to 2017, and so we're 15 billion to 20 billion, right? We're a $95 billion economy, and we're 15 to 20 billion below trend. That's tourism, right? We need another tourism industry, and that ain't gonna happen because the tourism authority, their objective is to decrease the visitor count. We dismantle telescopes. We don't build telescopes. And to pick up on the earlier discussion, home building on Oahu, it's so good, only World War was worse. And I'll leave it at that.
Hi. Thank you for having me. I'm really happy to be here and present you his perspective on the Hawaii and broader economic conditions. So since our last forecast, which came out in the spring, conditions have worsened quite a bit. And there is a whole range of those things that have gotten worse. So first of all, COVID is not gone. And I'll talk about more of each of these bullet points as I go through my slideshow. This is just an overview. We have inflation, we have rising interest rates, and these obviously impact costs, business costs. The inflationary pressures also affect demand. Up until the end of last year, we had essentially support from the federal government in terms of fiscal payments to households and childcare. That's gone now. And this year, Russia invaded Ukraine, which actually exacerbated all the problems that we have started feeling at the beginning of this year. In Hawaii, we have still the similar issues as at the national level. Obviously, when the US economy is suffering, that affects our tourism industry and indirectly affects Hawaii's economy. And so the interest rates rising obviously affects construction and housing. So let me look at each of these separately. So the first risk that I mentioned is COVID. COVID is still around, although we learn to live with it. But as we have seen recently in the news, restrictions are easing across the world. But if you look at China, for example, COVID still has a huge economic effect. It can disrupt supply chains. At the same time, as restrictions are easing, economies are catching up. As an example, we have Japan in red on the slide, and Japan is one of the countries that went through this whole period without a major outbreak. And then it happened with BA.5. While they had this outbreak, they started easing restrictions. That's when they started raising the cap on travel. And they just this week also announced that they're gonna raise the cap on travel further and ease other restrictions. So the point of the story is that we just learn to live with it, I think. In Hawaii, we just learned that UH will not require masks anymore in classes starting from next week. And so all this bodes well for future activity, but we have to remain vigilant in case we have another major wave and perhaps a more infectious or deadly variant of COVID that may still lead to disruptions. Another risk that I mentioned is inflation. In this graph, you can kind of see that inflation started picking up way before Russia invaded Ukraine. You may all remember the pictures of the container ships in Los Angeles harbor last week, right? So that's when, as Paul used the supply-demand charts, demand outstripped supply, and we started seeing the rising prices. On top of that, when Russia, and even energy prices started rising at that point, but when Russia invaded Ukraine, energy prices accelerated. Now, the good news is that gasoline prices have come down a little bit since then, since the peak, but it doesn't mean that inflation is going away. Why? Because those energy prices, the energy was used to grow crops, to build buildings, and these things will come to market in the next months, quarters, years. So these price shocks will be with us for a while. What you see in this slide also at economic outcasts, right? So this is the IMF making predictions about inflation. And as you can see, they missed it each time. They had to raise it each time they made a prediction. So we'll see how it goes forward. Obviously, they are predicting a decline soon. And as I'm just saying, the price effects will last a while. It's not going to come down immediately. The good news is that consumers and the market are not too upset about longer-term inflation. The green line is showing you the one-year expectations on inflation, and that obviously the current situation is baked into that. But then once we are looking forward 5 years, the average inflation over the 5-year period is essentially similar to what we have seen over the past decade. And I'm emphasizing this, these are the average inflation over the 5 years. So if we have now 9% inflation or 6% inflation, then the average over 5 years has to be at some point, you have to have lower inflations to bring it down. So that's the good news. How are we going to get there to the lower inflation? The Fed started raising rates, and it started raising them really fast. And what's interesting is that the market doesn't expect these rates to go too much farther than they are now. We are now at 2.5%. Expectation is next week they're going to raise, or 2 weeks from now, they're going to raise by another 75 basis points. And 4% is just another 75 basis point hike from there. So the market is actually expecting 2 75 basis point hikes and stop there. In fact, as you look at the tail end of that line, it's tilting downward, which implies that the market expects weakening economic conditions, and therefore the Fed to lower interest rates. So they expect that we might actually see a decline in interest rates very soon. So what does all this mean for our forecast for the US economy? This is GDP growth, and the blue bars are what already happened, and the orange bars are what we expect to happen. So 2021, the bigger bars are the recovery from the recession. And then at the beginning of this year, we had the shocking news that GDP actually declined, and then it declined again. Still, we are not in a recession, but that's just between economists who are arguing either way. The point is that the economic conditions started slowing. We had inflationary pressures started to rise, and then going forward, this is actually going to get worse with the Fed raising interest rates. So both of these things affect costs, business costs. It also affects, inflation affects demand, right? And then we do expect in the third and fourth quarter of this year a little bit of recovery from the last 2 quarters as we are heading into the holiday season. But then starting next year, at the beginning of next year, the downward orange bar, that's when actually the Fed policy kicks in and starts really slowing the economic conditions. And what my theory is about, our theory is about how this is going to happen, as you have already heard today, businesses have a hard time hiring people. So they try to retain the people they hired already, right? And so now you are actually in the situation of labor hoarding, where you are keeping the people, even though maybe down the line you won't need them. Because with growing interest rates, you may have less demand, but you will have the staff. And so at some point, perhaps after this year is over, people will realize that the music is over and they need to start let people go, right? And so that's the danger going forward. This slide illustrates the difference between labor markets in the US and Hawaii across 4 recessions. So the blue line is always the US and the green line is Hawaii. And depending on what time period you are looking at, it's very different. So the first top left is the 1991 recession and then the lost decade. You see the US recovered and then kept going while Hawaii just stayed at the same place. The next one next to it is essentially the 2000s up until the housing crisis. Then we have the housing crisis in the bottom left. And then in the bottom right, we have the current recession and recovery. So obviously, the experiences at the national and the local level can be different. And the main reason for the difference is typically tourism. And that's especially true now when the US effectively recovered. The US labor market has completely recovered its losses, while Hawaii is still down 60,000 jobs. And again, the main difference is tourism. The US was essentially, the whole country was supported by the fiscal policy and it was effectively on steroids, but it still wasn't enough to bring back Hawaii from the doldrums. I'm just gonna look at my time. So continuing with the labor market theme, the 2 lines here are, the blue line is non-farm payrolls or jobs, and the orange line is employment. These are 2 measures of the labor market, but they are different, and they are really different this time around. The question is why? So jobs are, the information on jobs is collected from firms, and each job counts once. The employment line is capturing the number of people who claim they are employed. That's a household survey. So typically the employment line is above the blue line. That's typically the case. But when you, instead of holding 2 jobs, you only hold one job, then the non-farm payroll line is going to be much lower, right? So this is the situation in the current recovery. Many people who previously before the pandemic held more than one job, many of them now only hold one job, right? And so therefore the number of payrolls is lower than in the past. So that's one explanation. The other explanation is that many people actually didn't take jobs at companies. Instead, they started their own business or they started working in the gig economy and driving Uber and so on. And so this may explain the difference, but the point is that there is still a slack in the labor market, right? And another way to look at the labor market is to look at what the pay is. How much money do people take home? The blue line is US real average hourly earnings, and the green line is the same for Hawaii. Yes, the level is different, but the key point here is that if you look at where the line ends, it's about the same level where we were before the pandemic. There's an artifact in these lines. So what happened was we had the continuing slow growth in real earnings, right? And then when the pandemic hit, many companies started letting go people who were in service jobs. These are typically low-paying jobs. So at the same time, the people who remained in their jobs, they are the higher-earning people, so the average earnings went up. So this composition effect is now unwinding, but at the same time, once we get back to the same labor force effectively, we will end up effectively at the same real earnings as before the pandemic. Now, why is this important? The Fed is worried about an inflationary cycle where as prices go up, wages catch up, prices go up, wages catch up, and we have this spiral that could go out of control. But looking at this picture, it indicates that that's not a danger at this point, right? Wages are growing slower than inflation, effectively. And so, having talked about the labor market, the question is now, what do we see going forward? Is a soft landing still possible? And so this is effectively cash balances or savings that people can use for consumption. And you see that these cash balances doubled during the pandemic. Actually, while Paul was talking, Carl Bonham just slacked me that the number went up in the last quarter. So they just released the numbers and went up. So what that means is that households are relatively, they have relatively healthy balance sheets. And this theme came up earlier today when we talked about the housing crisis and how this time the recession and the recovery is different from the last one. So there is a chance that we will see a soft landing, but it's going to depend on many other things too. Turning to Hawaii and the tourism industry, this slide shows our forecast. This is actually officially called a spaghetti plot, okay? And it shows our forecasts over the last 3 years. And what you see at the beginning, before the pandemic hit, we were forecasting a steady growth in visitors or flat level of visitors. Then the pandemic hit, and then we started forecasting gradual growth. The red line is the actual number, actually what happened. So what you notice here is that our forecast tended to be a little on the low side. So we were surprised by the healthy recovery in the tourism industry in last year. But then going forward, we feel like the momentum is slowing. And why is that? So this chart shows you the tourism industry broken down by market. The green line is US, the blue line is Canada, the gray line at the bottom is Japan, and the orange line is the other international markets. So the US has outperformed everyone's expectations. Canada has been catching up, but the rest of the world is just coming along, and everyone is hoping that once the Japanese visitors arrive, we will be safe. Now, the problem is exchange rates. And so here you see the blue line. This is what I would like to bring your attention to, is the Japanese yen. It lost 20% of its purchasing power, which means that if a Japanese visitor wants to come, the trip just became much more expensive. How much more expensive? So this slide illustrates the difference in expected spending. So let me just illustrate this with the left side first for Canada. The shorter bar is the spending by category for Canadian visitors in 2019. So there is food, transportation, lodging, and other expenditures. Under other expenditures, think about them as discretionary spending for a visitor. It's like shopping. So then we inflated that basket of goods to the 22 prices, and the longer bar for Canada represents what they would be spending if they bought the same basket of goods this year. And the black line represents what they actually spend. So Canadian visitors spend exactly the same what you would expect if they consume the same basket of goods as they did in 2019. But if you look at the left, when you look at the left, that's Japan. And for Japan, again, because of the exchange rate, the basket of goods that they were consuming in 2019 just got 53% more expensive. So that red arrow up indicates that the amount that, from their perspective, domestic yen, they would be spending 50% more on a visit than they did in 2019. And the question is, even if we see a recovery of Japanese visitors, how much will they spend and where will they save? They can't save much on lodging, they can't save much on transportation. Probably they will save on shopping. So before I conclude, so let me just briefly mention the construction industry. We have an interesting situation currently in the construction industry where the construction jobs have been declining over the past year. The reason why it's surprising is because if you look around in town, you notice all the high-rises going up, and the permit numbers, at least based on what we hear from the DPP or the permitting offices, are really strong. And they are really strong in government. So the orange band is government permits or authorizations, and it's much thicker than in the past. And that may sustain the construction industry at the current level for a while. But if you are thinking about residential housing, the problem there is that in the past 2 years, many people decided to fix up their homes, and there was some building activity ongoing. But going forward, the residential market is going to suffer from the high interest rates. So here the blue line is the single-family home price, and the orange line is the affordable price. Now, why are the two different? The two are fluctuating mainly because of mortgage rates. When mortgage rates go up, affordability goes down. So that's the orange line. And then, so if you factor in the increase of mortgage rates from about 3% to about 6%, and the increase in single-family home prices from about 800,000 to about 1.1 million, and you look at what would be the monthly payment now and what was it 2 years ago, you are paying double. That's your monthly payment. It went up. So this is my last slide, and thank you for having me. Just one last point. I didn't have too many forecast figures here, but in 2 weeks, we are releasing our third quarter forecast, and we will post it on our website, and you can learn much more about our thinking at that point. Thank you.
Good afternoon. I was given the assignment to talk about the local economy. Let me just go straight to the numbers. This is a summary of the forecast for the world. This is from Blue Chip Economic Indicators. This is from August, but I believe coming Monday, there will be September. Our projections will be coming out. But there are two significant trends. One is you look at the US, the economic growth for this year is only about 1.5%. Next year is 0.7%. So this is greatly decreased. When you look at it every month from the beginning of the year until August, there are two numbers. Every month is changing. Economic growth has been every month is declining, and inflation every month is increasing because of the things happening. And most of the economists don't know what is going to happen. So they keep changing the numbers. So given that, I look at the local economy in 4 areas. One is the tax revenue collection, and second is the labor market conditions. Third is the construction, and the fourth is tourism. So I look at it, this is our forecast. We release on the last day of August. So there are two numbers you may want to look. I think one is visitors arrival. Our forecast is that we will not fully recover until 2025. So the visitor recovery currently standing at about 87%. But it's not going to be fully recovered. And secondly, our job count is not going to be fully recovered until 2025 as well. Our GDP recovery currently is about 95%, and our job count recovery is about 92%. The US GDP already recovered last year, and the job count is fully recovered this year. As Paul mentioned that the fully recovered, but is not on the trend yet. So it's still not on the growth trend. So we look at the details by, this is the details by county, because I'm looking at the local. So you can see that by county, the recovery, so is actually the drag for the growth is mainly on Honolulu. So I have a feeling that the neighbor island economy has already recovered, but Honolulu is falling behind. Mainly, there are two indicators. One is the tourism. The visitor recovery in Honolulu is still very low, and the construction permit issuance is very low. I think those two are the areas happening in Honolulu, because Oahu is about 50-50 visitors, 50 international, 50 domestic. Neighbor Island is about 15 international, 85 domestic. But domestic has already been recovered, and it has been all-time high. For the first 7 months, the recovery rate is 12.4% higher than the same period in 2019. And international recovery is 33.8%. Japanese is only 6.7%. So Honolulu is suffered from the lagging of the international, especially Japanese recovery. Look at it, this is the, I look at it, this, I think this is the old slide, the old version, I think. So basically, What it is the, I look at all the counties, and I look at the local data is the general tax liabilities, and I look at the inflation rate. So if the inflation rate is more than 100, and if 105, that means 5% higher than the same period 2019. So if you compare the last column with the previous counties, you can see that the counties, in terms of general excise, actually, they are actually, most of them, higher than the inflation. That means in real terms, they recovered. But if you look at all the lines, for Honolulu County, they are not. So Honolulu County is the most troublesome county in terms of economic recovery. So look at this chart. It is the, mainly it's by industry recovery. So the recovery, a lot of industries, they actually, this is for the first quarter 2022, that's GDP recovered by about 95%. But you look at it, the industries still lagging is tourism related, which you can see is transportation and food accommodation, food services, hospitality, basically, and entertainment. So they are the ones is still falling behind. And if you look at the county, this is the job recovery. I think by the county, the recovery is pretty much similar for all the counties. The tourism is still falling behind. I think we use this monthly benchmark number. I think our number showing that we still have about 43,000 jobs to be recovered. I think Peter reported Uhiro used a benchmark number. So their number is higher, is at about 60,000. So in any measure, I think our labor market is not, it takes a few years to recover to the pre-pandemic level. And this is shows the blue line shows the job opening, and the green line shows the hires. The gap in between is the unfilled positions. So you can see starting from last year, 2021, until this year, into this year, is the gap is pretty high. That means there are more positions unfilled. And that is why a lot of business claim that it is difficult to find the workers. But at the same time, we have more people looking for jobs. So this time, it is the first time I have seen that there is either a mismatch or there's a lot of people, they are not looking for jobs, or they change their business or lifestyle, changing from working from outside of firms, and also changing from a payroll job into a self-employed jobs. And we will look at the construction. So this is another area I look at it, and the top line is inflation adjusted. The private construction, the building permit. You can see that we have a decline in the recent months, especially from the beginning of the year. But if you look at the government contract awarded, it has been very high. If you look at the scale, look at the left-hand scale for the private construction building permit. If you look at that scale and compare with the government. So the government contract awarded, it is very high. If you look at the scale, so they actually, in the month of June, they awarded about $4 billion. So it is very high. But the government contract awarded has a nature, it takes longer time. For example, the June contract awarded is from Navy, and the length is about 6 years. So you don't know when, and we see a good future, but it's not going to be impacted in the current construction activity. So this shows another indication that you can see the construction jobs is actually started to decline, while the total jobs is actually still increasing, but the construction jobs is declining. And this shows another indicator is the retail sales. We actually had a building material sales in the retail stores has been increasing every single month during the pandemic, 2020, 2021. But starting this year, starting in March, we see the material sales is declining. So when you see the first April to May period, the building material sales is declining. So this is another indication. We see all the areas, tax revenue still strong, labor market is very strong recovery, tourism, strong recovery. The only sector we see slow is actually the construction sector. And this shows the visitor recovery. And I have shown the monthly by island. So you can see that Neighbor Island recovery is very strong. For certain months, it's pretty much fully recovered. Not for Oahu though, but it's going up and down. It goes with also the COVID cases. So when the COVID cases increase, the visitor tend to decrease. I think for the month of July is the latest, we see over 90%, 92% recovery. This is I believe this is my last slide. It shows until the end of the year, the supply side of the tourism, which is the air seat. And for the other market is pretty much stable. But for Japan market, there may be some adjustment because if you look at November, December, the recovery is about is over 90%. But actually the recovery should be around 60%. That's the only market is lagging. We have a recovery from Canada, visitors recover about 60%. And the other international, the recovery is about 50%. So if that Japan market will keep up, and I think that will be some hope. But we expect that when the time goes close, they will be making some adjustment. I think this is my last slide. I will be waiting for the questions at the end.
All right, good afternoon, everyone. They saved me for last, I guess because I don't have a PhD and they put the less educated people at the end, right? My background is in commercial real estate. So what we try to do is take all the brilliant economic news and try to boil it down to how does it impact each of these sectors. And commercial real estate actually is a reflection of the business environment more than anything else, and how it's impacted by the economy, by monetary and fiscal policy, by financial markets, and by real estate marketplace. So when we start with the broadest measure, here's our agenda for today. We're going to talk about the investment market and go into office, industrial, retail. So for the first sector is the investment market, which is the broadest measure of our real estate sector. Basically what this is, it indicates that this is as of 6 months into 2022. This is most recent data. Nobody's seen this yet. We haven't published a report on it. So you guys are the first to see this. So whoever's a reporter, don't put it in the newspaper yet. We're not ready yet. Basically what we're seeing is that we've had a steady increase in sales volume. All of these bars, these blue bars, indicate 6 months of investment transaction activity for Hawaii. So as you can see, the last number there shows that we've had the second consecutive year where we've had increase in transaction activity and sales volume, which is supposedly very positive news because it shows that capital is flowing back into real estate. Transaction counts, 182, very close to record level, which happened last year. So what we're wanting to do is also look at mega deals. And for Colliers, a mega deal is anything over $100 million in sales price. It's also an indication of institutional money looking for opportunities here in Hawaii where capital flows into the state. So what we're seeing is that after a significant decrease during the pandemic period, 2022 shows a slight increase of about a positive $500 million worth of transactions. And those are only 3 transactions for the year so far for mega deals. For those of you in real estate, the first one is the Element, which is a multifamily development out in Kapolei, Oasis Townhomes, which is another 300 or 400 units in Waipahu, and Ho'opili Business Park, which happens to be the industrial park that was acquired by Costco. So that is an indication of what real estate property types are the most are of highest interest: multifamily and industrial. Here locally, the local investor still remains very active. Almost 90% of all the transactions here in Hawaii are under $10 million in sales price. So for the bankers who loan on commercial loans, real estate loans, that's their bread and butter. So what we're seeing is still fairly healthy local market in terms of interest in commercial real estate. Now these graphs are a little more difficult to see, but basically it supports the idea that multifamily still remains the bread and butter of commercial real estate here. For those of you who had been in the earlier presentation by Stanford Carr and Christine Camp, multifamily still remains the most or the highest interest level in terms of what the dollars are being spent in and also where the transactions are occurring. As mentioned earlier, a lot of the institutional money is coming from the mainland, and that's where roughly about 80% of the dollars are coming from, whereas transaction counts locally still remain very popular. I mean, local investors still are interested in real estate here, commercial real estate. So the bottom line in terms of how rising recessionary fears, which also translates to increased interest rates, which also relates to increased uncertainty by investors, what we've had in terms of our forecast going forward is that we're going to see a slowdown in the latter half of 2022 and probably into 2023. Should a recession occur, investors are going to pull off to the sideline, they're going to hold their capital and wait until more sure conditions occur going forward in terms of real estate. So just a quick summary on that is that, you know, rising interest rates, I know that's going to be a question coming up, has a negative effect on commercial real estate as well as residential real estate, as you've seen by our economists in terms of their numbers. What we hope is that what happens is that real estate is also a safe haven during a recession. So real estate doesn't lose very much value during a recession, and that's a good place to hold money on the sideline going forward. So that's the investment market. The office market is kind of an interesting factor. We've hit record highs in terms of vacancy rates. Absorption, for you, those of you who don't know what absorption is basically when there's a decrease in occupancy, it's a negative number. So we've had about 145,000 square feet of negative occupancy. Combined with the previous 3 years, we're well over 500,000 square feet of negative absorption. So for those of you who work in the office environment, you guys haven't gone back. And as Paul mentioned, all of you guys are probably not going to, or part of you are not going to go back. So ultimately that impacts negatively on the office demand. As Eugene mentioned, job counts haven't returned to normal or to pre-pandemic levels. One of the things that we measure in commercial real estate is sublease space. For businesses that are cash-strapped and are facing difficulties, they take part of their office space and they put it on the market to try to recoup some of their overhead. If there's an increase in sublease space, usually it's an indication of businesses still facing some financial difficulties. And ultimately, what we keep our eye on is there an increase or a decrease? This slide shows that prior to this past quarter, there was a decrease in the amount of sublease space. And that's primarily because infection rates were improving, things like that were actually showing positive growth. That sublease space decreased, but in the past 3 months, we've seen a kind of a change in that reaction there. Another thing that we look at is lease term length. The longer the term length, tenants tend to think, okay, well, I feel safe, financial outlook looks good for my business, I'm going to secure a longer term lease. If lease term rates shorten, generally it's an indication that they're concerned about their future, and both landlords and tenants agree that let's shorten the lease term to accommodate that. Now, we haven't really talked about how the pandemic has impacted office. Also, what's happening is with the concerns about the recession, remote work is probably going to be a factor that's going to happen continue to happen over the next 3 to 5 years is what we anticipate at Colliers. So our forecast for the office market is that vacancy rates are going to even surpass the record high that occurred this quarter and surpass 14% by year-end 2022 and probably continue to increase until there's a stabilization in when, first off, as the pandemic starts to wane. Second off is that there's an encouragement for workers to come back to the office environment without having them being concerned about getting infected. So office market has gone through significant transition, and what's kind of interesting, and we can talk about this in a future discussion, is that the differences between the generations, Gen Z, Gen X, Gen Y, and the baby boomers, they're all differ in terms of whether or not they want to come back to the office or not. Okay, I'm going as quickly as I can. It's the industrial market now. So what's kind of interesting is amongst all the commercial real estate sectors, the industrial market was one of the areas that actually boomed during the pandemic. Vacancy rates fell to a record low 1.38%. That's historically low, never happens in the past. Absorption, which is growth in the market, was about 92,000 square feet. That's not a whole lot, but if you only have a little bit amount of space on the market for lease, that's practically all the available space that's on the market is being taken up fairly quickly. And by the way, rents jumped in the past 6 months by 8%. So if you're a warehouse owner or industrial space user, you got some big concerns going forward in terms of trying to find what's available out there. So this is the historical demand, shows that industrial markets will continue to remain tight going forward. We didn't talk about the growth of Amazon, Costco, Target, Walmart, FedEx, UPS, DHL, because one of the things that was discussed at lunch was logistics. And logistics, that market has grown significantly in the past 3 years because all of you have gone out and relied on Amazon to buy your goods. And now you're waiting for last mile delivery and you want that thing. I ordered it yesterday, it better be at my door today. And the only way that's going to occur is if we have last mile delivery, which is services related to the industrial sector. So we have very limited amount of space out there. We talked about Amazon's impact on our marketplace, and vacancy rates going forward is going to remain 2%. So of all the commercial markets, from a real estate perspective, it would be really good if you had purchased some warehouses a couple of years ago. Okay, so here's a quick summary. We're anticipating rental rates to continue to increase. We don't have a lot of speculative construction occurring in this marketplace, so what that means is that cost of goods for delivery to you will continue to rise, and that's going to continue to be fueled by inflation. All right, we saved the last and probably the most challenging market out there. You heard earlier in the session by Nalu and by LNL how challenging it is to stay in retail. Well, one of the things that we're concerned about is that vacancy rates have risen to about 7%. Overall, it's not scary. 7% is not a bad number. But overall, if you were looking 5, 6 years ago, prior to all the construction that occurred at Ala Moana and Kamakana Ali and International Marketplace being added to the marketplace, vacancy rates here in Hawaii were about 2 or 3%. So we're triple or that number as of just about 5 or 6 years ago. Now here's some of the indicators. We have slight negative absorption. As our economist mentioned, retail sales actually didn't suffer. You had all this money that you guys are accumulating from the CARES Act that you decided to go out shopping, so that kept some of the retailers alive here in our marketplace. As a result, surged to $25 billion, and this is a 12-month rolling average, rolling 12 months for 2022. And we mentioned that about job counts having returned to the same level, and I'm going to bring back to my office what Paul mentioned, is that you got 1 million people that died because of COVID, they're not going back to work. And I think that's a really good point, because not that say that Hawaii has lost that many people, but you have a lot of people in the service sector that had worked in restaurants and retail, got laid off, and didn't want to go back to the retail store or the restaurant because they didn't want to get laid off again should a pandemic surge. So they probably went off and looked at different jobs as alternatives, which is, I think, really what happened. This was discussed before. Some of the interesting trends going forward from a retail perspective is, how many of you gone to Home Depot and noticed the mobile scan and go? You can actually take a scanner and actually scan the barcode and they'll charge it directly to your credit card. Contactless, basically it's been around for a long time. You just scan your card or have them, even when you go to Costco for gas, you don't touch anything, you just put it on the gas meter and they automatically charge you. Thirdly, BOPIS, buy online, pick up in store. And also there's curbside pickup. So all of these trends are likely to continue. And I just got back from South Korea, and a way they're gonna save money on manpower, this is gonna be all technology. You're just gonna order when you first go in, they're gonna bill you on your credit card, and you're gonna go pick it up, and basically there's nobody serving you, nobody's serving as a cashier for your services here. All right, so hurdles. One of the things that was mentioned in the conversation in the previous session is that DPP issues. This was a big issue with our brokers, because what we're dealing with is, if you lease a space and you haven't negotiated the length of term it takes for them to actually build out the space, those retail stores cannot open. They cannot generate sales. They cannot generate sales. They're going to close because they haven't been able to generate business. So it's a big issue on that. Other things related to retail challenges is inflation. You could go out and buy stuff, but it's going to be 20% higher than it was before. Supply chain issues still exist for retailers. If you go shopping for Christmas gifts, make sure you go early, because you can order it now. It might not even be here by Christmas time. And then labor shortages, which were discussed earlier. So that is a quick summary of the industrial, investments, retail, and then office sectors, which kind of, hopefully, you'll see how the economy and all those factors that were discussed earlier impacts the business environment here in Hawaii. And thank you for your attention.